In March of 2023, three American banks failed in the space of 8 days: Silicon Valley Bank, Signature Bank, and a few weeks later, First Republic. Combined, they were the second, third, and fourth largest bank failures in American history. Almost nobody talks about the detail that actually matters here. None of those banks were reckless in the way we usually picture bank failures. They weren't making subprime loans to people who couldn't pay them back. They were holding some of the safest assets regulators recognize: long, dated U.S. Treasury bonds. The problem wasn't the quality of what they owned. The problem was what happens when interest rates move faster than a balance sheet was built to survive. That single idea explains why gold has behaved the way it has for the last 3 years, and why a growing number of professional reserve managers, the people who manage trillions of dollars for central banks and pension systems, have quietly stopped treating gold as a relic and started treating it as insurance. Insurance against something most people haven't fully connected yet. The next stress event in the banking system may not look like 2008, and it may not look like 2023 either. But the mechanisms building underneath the surface right now resemble both a little too closely. Let's stay with 2023 for a moment, because most people misremember what actually happened. The common story is that Silicon Valley Bank collapsed because of a bank run. True, but that's the last domino, not the first one. The first domino fell years earlier, when the bank took in an enormous wave of deposits during a period of near zero interest rates and parked much of that money into long-term government bonds. At the time, that looked conservative. Treasuries are about as safe as it gets in terms of credit risk, but bonds carry a different kind of risk that has nothing to do with credit. It's called duration risk. When interest rates rise, the market value of existing bonds falls because nobody wants to buy a bond paying 2% when new bonds pay 5%. Silicon Valley Bank's bond portfolio lost value as the Federal Reserve raised rates aggressively through 2022. None of that mattered on paper as long as depositors didn't ask for their money back all at once. But depositors did ask. Word spread through founder group chats and venture capital networks faster than any regulator could react. And in a single day, customers tried to withdraw $42 billion. No bank survives a run of that speed, no matter how well it's run. There's a piece of this story that matters more than the bank run itself. The Federal Reserve and the FDIC responded within 72 hours by guaranteeing all deposits at the failed banks, even deposits above the $250,000 insurance limit, and by creating a new emergency lending facility that let other banks post their underwater bonds as collateral at face value instead of market value. The intervention worked. It stopped the panic from spreading to healthier banks. But think about what that intervention revealed. A meaningful slice of the American banking system was holding assets worth less than their stated value, and the only thing standing between an orderly system and a cascading crisis was the central bank's willingness to paper over that gap with new liquidity. Reserve managers around the world watched that unfold in real time. What they took away from it wasn't panic. It was a quiet rethinking of how much trust to place in paper promises versus something that has no counterparty at all. One detail from the Silicon Valley Bank story got buried in most of the coverage, and it explains why the fear spread as fast as it did. The FDIC insures deposits up to $250,000 per account. That limit was set decades ago with an ordinary household in mind, someone with a checking account and a savings account. It was never really built for a venture-backed startup keeping $8 million in a single operating account to cover payroll. At Silicon Valley Bank, close to 90% of total deposits reportedly sat above that insured threshold. So when depositors did the math, they weren't calculating a small risk to a small slice of their savings. They were calculating a real risk to nearly all of it. That's not irrational panic. That's rational, self-interested behavior from sophisticated depositors doing exactly what you'd expect once they realized the safety net underneath them was thinner than everyone had assumed. Which raises an uncomfortable question. How many other banks still carry a similar concentration of uninsured deposits today, sitting completely untested, simply because nothing has yet forced their depositors to run that same math out loud? Sit with that for a minute, because it explains almost everything that follows. Every dollar in your bank account is technically a promise. It's the bank's promise to hand you your money when you ask for it, backed by the government's promise to make you whole if the bank can't. A treasury bond is a promise too, the government's promise to pay interest and eventually return your principal. These promises have worked so well for so long that nobody thinks of them as promises anymore. They're just money. Gold isn't a promise. It doesn't depend on an institution honoring an obligation. It sits in a vault or in your hand, regardless of whether any bank, government, or clearing system is functioning normally that day. For most of modern financial history, that distinction stayed almost entirely theoretical for everyday investors. Over the last 4 years, for a specific and growing class of institutional buyer, it has become extremely practical. Now look at what the data actually shows, because this isn't speculation, it's measurable behavior. Central banks bought gold at a pace above 1,000 tons a year in 2022 and 2023, and again in 2024, according to the World Gold Council's tracking official reserve activity. For context, the average annual purchase in the 2 decades before 2022 sat somewhere between 400 and 500 tons. Central banks didn't just increase their buying. They roughly doubled or tripled their long-term baseline and held that elevated pace for 3 straight years, something the modern data series had never recorded before. In 2025, purchases eased slightly to somewhere around 860 tons by some estimates and well over 1,000 by others depending on methodology, but even the conservative estimates sit dramatically above the old historical average. In the first quarter of 2026 alone, central banks added roughly 244 tons, a figure that beat the prior 5-year quarterly average and, according to several market analysts, extended what may be the strongest sustained sovereign gold buying run since 1967. Here's the part that should genuinely surprise you, because it runs against almost everything textbook economics teaches about how large, sophisticated buyers behave. Central banks are, in theory, disciplined institutions with mandates, oversight boards, and public accountability. Classical theory would predict that as an asset's price rises dramatically, a price-sensitive buyer slows down, not speeds up. But gold's price roughly doubled between January 2025 and January 2026, moving from around $2,700 an ounce to briefly touching an all-time high above $5,500 in late January 2026. Central bank buying did not slow down in response to that historic run-up. If anything, the pace in early 2026 stayed near record territory. That isn't how price-sensitive institutional capital normally behaves. It's how insurance buyers behave. Nobody stops buying fire insurance because the premium went up. You buy it because you've decided the risk of the house burning down is real and going uncovered isn't worth the savings. So who's actually doing this buying, and what does it tell us? Poland's central bank has been the largest single sovereign buyer for 2 years running, adding over 100 tons in 2025 alone and pushing total reserves past 550 tons. Poland sits on NATO's eastern frontier, bordering both Ukraine and Belarus, and its central bank governor has said plainly in public comments that this is about strategic insurance against extreme geopolitical scenarios, not a return chasing trade. Kazakhstan posted its highest ever annual gold purchase. Brazil came back into the gold market after a 4-year absence. China has been adding gold in a sustained, multi-year pattern, part of an openly stated strategy to reduce dependence on any single reserve currency. World Gold Council survey data shows more than 40% of central banks plan to increase their gold holdings further in 2026, and the large majority expected global official reserves to keep growing over the next 5 years. When more than 20 different institutions across different continents and different domestic politics are all buying and describing it themselves as diversification and insurance rather than a profit trade, that's not a trade you're looking at. That's a shift in how sovereign balance sheets get built. There's a broader current underneath all this individual buying, and it forms the backdrop for everything else. The dollar's share of global central bank foreign exchange reserves has been sliding for 2 decades, from roughly 71% in 2001 to somewhere below 57% by late 2025, according to IMF reserve composition data, the lowest share on record since 1995. That's not a collapse, it's a slow, grinding drift. And it's worth being precise about what it does and doesn't mean. The dollar still settles somewhere around 88 to 89% of global foreign exchange transactions, and U.S. Treasury markets remain, by a wide margin, the deepest and most liquid government bond markets on Earth. Nothing here says the dollar is losing its spot as the world's primary reserve currency anytime soon. But reserve managers don't need to believe the dollar is collapsing to justify diversifying away from it. They just need to believe that concentrating too heavily in any single currency, one whose issuing government can freeze assets as a policy tool, carries a risk worth hedging against. That belief got a very public confirmation in 2022 when Western governments froze roughly $300 billion in Russian central bank reserves after the invasion of Ukraine. For reserve managers everywhere, not just in Moscow, that was a watershed moment. It showed about as directly as possible that dollar-denominated reserves aren't politically neutral. They can become inaccessible overnight based on decisions made in Washington or Brussels, whether or not your own country is the one facing sanctions. Gold doesn't carry that vulnerability. Nobody can freeze a gold bar sitting in your own domestic vault. One detailed 2026 academic analysis of reserve composition found gold's share of total global reserves, measured alongside currency holdings, has climbed from around 13% in 2017 to close to 30% by 2025, with the BRICS bloc and its expanded membership now holding roughly 17% of global gold reserves, up from about 11% just 6 years earlier. That's the de-dollarization story in its most measurable, least speculative form, not a currency collapsing, just a slow, deliberate widening of what counts as safe, which raises an obvious question. Insurance against what exactly? To answer that, we need to leave the gold market for a moment and look directly at the banking system, because the answer is sitting in plain sight in the numbers, even though most financial news hasn't connected the dots publicly. Start with commercial real estate because it's by a wide margin the most concentrated risk sitting on regional bank balance sheets right now. Data tracked by TREP cited across multiple 2026 market analyses puts roughly $930 to $936 billion in commercial real estate debt scheduled to mature during 2026 alone. That's up somewhere between 18 and 19% from 2025. Running at more than double the 20-year historical annual average of roughly $350 billion in maturities. Why does a maturity wall matter so much? A loan maturing isn't just an accounting entry. The borrower has to either pay off the debt in full or refinance it at whatever the current rate happens to be. Many of these loans were written years ago at rates below 3%. New commercial real estate loans in 2025 were going out at average rates around 6.2%, more than double what a lot of borrowers locked in originally. For an office building where rental income hasn't grown, and in plenty of cases has shrunk because tenants haven't renewed leases, that math just doesn't work. The building's income can't cover the new, higher debt payment. Office real estate specifically is the pressure point here, and it doesn't look like a temporary dip. Office delinquency rates have run somewhere between 6 and 12%, depending on the data source and window, with some analyses describing vacancy rates that now exceed levels seen during the 2008 financial crisis. Nearly half of all office-backed loans, according to at least one detailed 2026 industry analysis, are now considered underwater, meaning the loan balance is bigger than what the property could realistically sell for today. More than half of the roughly $100 billion in securitized commercial mortgages coming due in 2026 aren't expected to pay off at maturity, a sharp drop from payoff rates above 80% as recently as 2023. Over $25 billion in commercial mortgage-backed securities loans are already sitting past their maturity date without repayment, extension, or resolution, a level of unresolved distress not seen since the post-2008 cleanup. Why haven't regulators simply forced banks to recognize these losses already? Because accounting rules give banks real discretion. Loans held for long-term investment, unlike loans a bank plans to sell, generally don't have to be marked down to current market value on the balance sheet the way a traded bond does. A bank can carry a commercial real estate loan at close to its original face value as long as the borrower keeps making payments, even if everyone involved privately knows the underlying property is worth a lot less than the loan against it. Regulators call this forbearance when it's deliberate, meant to avoid triggering a wave of defaults during a rough but hopefully temporary stretch. Critics call it, less charitably, extend and pretend. Both descriptions can be true at once. The practice can be a sensible way to avoid unnecessary panic, and it can also be quietly widening the gap between reported numbers and economic reality the longer it drags on. Why does this land specifically on regional and community banks rather than the giant institutions everyone already knows the names of? Because exposure to commercial real estate is wildly uneven across the banking system. Money center banks like JP Morgan Chase, Bank of America, and Wells Fargo have highly diversified loan books where commercial real estate is one slice among many spread across geography and property type. Smaller regional and community banks are a different story. For a meaningful number of them, commercial real estate can run 25 to 40% of the total loan portfolio, often concentrated in a specific city or region, sometimes in a specific property type like suburban office parks. Congressional Research Service analysis published in 2024 noted directly that most of the loss-absorbing capital at many small banks is essentially earmarked for losses coming out of their commercial real estate books specifically. One widely circulated 2025 banking estimate suggested a loss rate of just 33% across a bank's commercial real estate portfolio would wipe out that bank's entire equity capital. Not damage it. Erase it. This is the same mechanism that took down Silicon Valley Bank, just wearing a different disguise. In 2023, the vulnerability was interest rate risk sitting inside a bond portfolio everyone assumed was safe because treasuries don't default. In 2026, the vulnerability is credit risk sitting inside commercial real estate loans a lot of people assume are manageable because they're backed by physical buildings. In both cases, the danger isn't one catastrophic event. It's a slow motion gap between what an asset is worth on paper and what it's actually worth if you had to sell it today, sitting quietly inside institutions that look from the outside like they're following every rule correctly. To be fair to the banking sector, and this matters if we want honest analysis instead of alarm, there's a real counter argument here. Several major regional banks, including Regions Financial, PNC, and M&T Bank, told investors on recent earnings calls that they expect commercial real estate lending to stabilize and even grow moderately through 2026. PNC's chief financial officer said directly that the bank's commercial real estate balances have largely stabilized. Lower rates following the Federal Reserve's cuts that began in September 2024 have helped a lot of borrowers cover their debt payments with operating income, and executives at several banks describe successfully refinancing loans as they mature rather than watching them default. At least 8 U.S. regional banks reported better commercial real estate loan performance, with lower non-performing loan rates in the most recent reporting period. This is a legitimate evidence-based bullish case for the banking sector, not wishful thinking. Extensions and workouts are happening. Roughly $600 billion of the original $900 billion in 2025 maturities got pushed out successfully to 2026 through 2028 instead of triggering immediate losses. Here's the honest way to read both of those facts sitting next to each other. Extending a loan isn't the same as resolving it. It buys time. It assumes either interest rates fall further, making refinancing economical again, or property values and rental incomes recover before the extension runs out. Analysts at Manulife Investment Management asked directly about bank balance sheet strength in a 2026 industry interview, described the situation as not yet systemic, but explicitly pressured if long-term rates stay elevated. That's an honest, non-sensational way to frame it. This isn't a certain crisis. It's a real, measurable vulnerability that depends heavily on which way interest rates move from here, and interest rates in 2026 haven't been cooperating with the optimistic version. Which brings us to a detail from earlier in 2026 that deserved more attention than it got. Zions Bancorp, a well-regarded regional bank, reported $50 million in third-quarter losses tied to commercial and industrial loans, and that single disclosure reignited concern across the sector about how much bad debt might still be sitting quietly on regional bank books, unreported, simply because it hasn't been forced into the open yet by a maturity date or an appraisal. One bank, one disclosure, $50 million. On its own, that's not systemic. But it's exactly the kind of data point professional analysts watch closely, because in both 2008 and 2023, the earliest visible cracks were small, isolated, and easy to wave off individually right up until they weren't. Now connect this back to gold, because the link isn't abstract, it's mechanical. When trust in a bank's stated numbers comes under question, even mild, early stage question, capital doesn't wait for the crisis to become official. It starts quietly repositioning. That's basically what a bank run is. Depositors, or in the sovereign case, reserve managers, deciding not to wait around and find out whether the promise gets honored. In 2023, retail depositors ran from Silicon Valley Bank into money market funds and into the largest, safest banks. In the multi-year pattern we've been tracing since 2022, sovereign reserve managers have been running from a narrower reliance on any single government's promise, and specifically from concentrated reliance on the dollar and dollar-denominated debt into gold, which carries no counterparty risk at all. It sits in a vault. Nobody's balance sheet has to be solvent for your gold to still be gold. That's also why 2026 price action in gold confused a lot of casual observers. Good analysis doesn't hide the messy parts, so let's walk through it. Gold fell about 16% from its January 2026 all-time high near $50, $400 down to around $40, $483 by mid-May, a real correction by any measure. The decline followed an oil price shock tied to the U.S.-Iran conflict disrupting shipping through the Strait of Hormuz, which pushed oil above $100 a barrel and lifted April 2026 inflation to 3.8% year over year, with energy costs driving roughly 40% of that increase. Higher inflation raises the odds the Fed holds rates higher for longer, which raises the opportunity cost of holding gold, an asset that pays no yield at all. That's a completely rational, textbook explanation for the correction. Nothing mysterious about it. Here's the detail that separates a temporary pullback from a structural reversal, and it's the single most important piece of evidence in this whole discussion. Even as gold fell 16%, central bank buying didn't meaningfully slow down, and physical bar and coin demand from individual buyers actually rose. Bar and coin demand climbed 42% year over year to around 474 tons in the first quarter of 2026, the second highest quarterly total ever recorded. Meanwhile, Western gold ETFs saw their largest quarterly outflow since 2023 during that same window, meaning a lot of faster moving Western investment capital did step back. But that outflow was more than offset by buying from Asian physical markets and continued sovereign accumulation. Two very different buyers were sending two very different signals. Fast money, The kind that trades gold like any other asset, took profits and stepped back when the price got volatile. Patient money, central banks, and long-term physical buyers kept accumulating through the dip. That split tells you a lot about which buyer actually believes this is a structural multi-year shift rather than a short-term trade. Silver deserves a mention here too, because it tends to get treated as gold's smaller sibling, and that undersells a meaningfully different asset with its own dynamics. Silver doesn't have anything close to the central bank reserve demand gold does. Almost no sovereign institution holds silver as a strategic reserve asset the way they hold gold. But silver has a substantial industrial demand base gold largely lacks, tied to solar panel manufacturing, electronics, and electric vehicle production, alongside its long history as a monetary metal and store of value. That dual identity means silver tends to amplify gold's moves rather than lead them. When confidence in the financial system weakens and investors rotate toward hard assets, silver often rides along with that safe haven demand, but it's simultaneously exposed to industrial demand cycles that have nothing to do with banking stress at all. That combination makes silver considerably more volatile than gold in both directions, and it's part of why analysts often describe it as a higher beta, higher conviction version of the same theme rather than an interchangeable substitute. Lumping gold and silver together as though they respond identically to the same headlines is a common mistake, and the price history doesn't really back it up. Now zoom out historically, because this exact pattern, gold rising for reasons tied to trust in the financial system rather than simple inflation, has a precedent worth understanding. In the 1970s, gold's dramatic rise wasn't just about inflation, though inflation mattered plenty. It was really about the collapse of the Bretton Woods system when the United States ended the direct convertibility of dollars into gold in 1971. That was, in essence, the world discovering that a foundational monetary promise it had relied on for decades no longer held the way everyone assumed. Gold went from $35 an ounce to over $800 by 1980. Driven substantially by a crisis of confidence in the monetary architecture itself, not purely by consumer price inflation. In 2008, gold initially fell alongside almost everything else during the acute panic phase of the financial crisis, as investors sold anything liquid to raise cash, including their winners, to cover margin calls and redemptions elsewhere. That's a pattern worth remembering because it means even a genuine, safe haven asset can fall sharply during the first days of acute panic. Before it's safe, haven character reasserts itself once the initial scramble for cash eases. What followed 2008 matters more for our purposes, as it became clear the crisis had required the collapse of Lehman Brothers, the forced sale of Bear Stearns, government rescues of Fannie Mae, Freddie Mac, and AIG, and eventually trillions of dollars in unprecedented central bank asset purchases through what became known as quantitative easing. Gold rallied from around $700 to over $1,900 by 2011. It's only fair to give equal time to the other side of gold's history, because a balanced take can't only cite the periods that support the bullish case. After that 1980 peak near $800, gold entered a brutal decade bear market, falling to roughly $250 by 1999 and going nowhere in real inflation-adjusted terms for almost 20 years. That collapse happened specifically because Federal Reserve Chairman Paul Volcker raised interest rates aggressively, pushing real interest rates sharply positive to break the back of 1970s inflation, and because confidence in the dollar and in central bank credibility got rebuilt over the following 2 decades of relative monetary discipline. That history matters a lot for anyone tempted to treat gold as a one-way trade. Gold's price isn't simply a referendum on doom. It's highly sensitive to real interest rates and to the credibility of monetary policy, and when that credibility strengthens rather than erodes, gold can underperform for a genuinely long stretch, long enough to test the patience of anyone who bought purely on a crisis story rather than understanding the mechanism underneath it. That 2-decade bear market is exactly why serious analysis treats gold as a long-term portfolio stabilizer, and a short-term crisis trade as 2 different things, related but not the same, and mixing them up is one of the most common mistakes in casual commentary. The lesson reserve managers took from 2008 wasn't just that crisis happened. It was that the policy response to a crisis of that scale requires creating enormous quantities of new currency, and every dollar, euro, or yen created that way is a unit that didn't exist before, diluting the value of every unit already in circulation. Gold can't be created by a central bank keystroke. That scarcity is exactly the quality being purchased. In both historical episodes, the common thread wasn't a single dramatic event. It was a multi-year process of institutions and the people who manage serious money rethinking how much they trusted the existing financial architecture to hold up under stress. There's an earlier, less remembered episode worth mentioning too, because it gave us a phrase that shaped how we think about banking crises ever since. In 1984, continental Illinois, At the time, the seventh largest bank in the country failed after a wave of bad energy loans and a run by large, uninsured institutional depositors, not unlike what happened at Silicon Valley Bank almost 4 decades later. Regulators worried its failure could cascade through a banking system it was deeply interconnected with, took the unprecedented step of fully guaranteeing all deposits, including those far above any insurance limit, and effectively nationalizing the bank temporarily to prevent contagion. A congressman at the time coined the phrase "too big to fail" to describe the implicit guarantee that had just been revealed. That phrase has shaped banking regulation and market expectations ever since, and there's a clear thrill in connecting 1984, 2008, and 2023. In each case, the actual rulebook, the one written in official documents about deposit insurance limits and free market discipline, mattered less in the moment of crisis than the unwritten rule that regulators will step in rather than let the system seize up. Reserve managers who study financial history closely understand that unwritten rule extremely well, and it factors directly into how much faith they're willing to put in any single government's promises versus an asset that doesn't need anyone to intervene on its behalf. What makes the current period different and arguably more significant is how long and how broad this cycle has run. This isn't a 6-month flight to safety after one crisis headline. Central banks have sustained elevated gold buying for 4 straight years now, spanning multiple presidential administrations, multiple Federal Reserve chairs worth of policy, and wildly different macroeconomic conditions along the way. From the 2022 inflation spike to the 2024 rate cutting cycle to the 2026 geopolitical oil shock. Behavior that consistent across that many different macro regimes usually isn't a reaction to any single event. It's evidence that ideas about what a safe reserve asset needs to look like are being rebuilt for a fragmenting geopolitical environment, one where sanctions, currency freezes, and cross-border payment restrictions have become normal tools of statcraft in a way they weren't a generation ago. So where does that leave an honest, balanced read on what happens next, since a responsible analysis has to lay out the real range of outcomes instead of picking the most dramatic one? 3 scenarios, all fairly argued. The bullish case for gold, tied directly to banking stress, goes like this. If commercial real estate losses at regional banks pile up faster than reserves can absorb them, even a handful of visible regional bank failures, not necessarily a full systemic event, would likely trigger the same reflexive response we saw in 2023: deposit flight toward perceived safety, emergency central bank liquidity facilities, and a fresh wave of institutional and retail capital seeking assets with zero counterparty risk. In that scenario, gold's role as the asset that isn't anyone's promise becomes the story again. And given how thin liquidity is in physical gold markets relative to the trillions in capital that could theoretically head for that exit, price moves could be sharp. The bearish case deserves just as much respect. If the Fed is forced to hold rates higher for longer because inflation, driven partly by energy prices and partly by a genuinely tight labor market, proves stickier than expected, the opportunity cost of holding a non-yielding asset like gold rises. Higher real interest rates have historically been one of the most reliable headwinds for gold prices, and if regional banks extend and hope approach to commercial real estate keeps working, meaning enough loans get pushed to 2027 and 2028 without forcing loss recognition, the acute stress scenario simply never shows up in a way that moves markets. Gold could consolidate, correct further, or drift sideways for a long stretch while other assets catch up. The neutral case, and arguably the one the evidence supports best right now, sits between those two. The structural buyer here, central banks, looks committed to a permanently higher baseline of gold accumulation, regardless of near-term price swings, which puts a durable floor on prices even without a crisis. At the same time, the acute banking stress scenario remains real, measurable, and unresolved, hinging heavily on where interest rates go and whether regional banks can keep extending and refinancing distressed commercial real estate debt. Analysts at places like Manulife describe the current state honestly as not yet systemic, but pressured, which is a very different statement than either all clear or imminent collapse. Who actually benefits and who's exposed in each of these outcomes? The effects aren't spread evenly, and that unevenness explains why different groups are reading the same set of facts so differently. Savers holding most of their wealth in bank deposits and short-term cash are the most directly exposed if regional bank stress turns acute, especially those above the insured limit and especially those concentrated at one smaller institution rather than spread across several. Borrowers with existing fixed-rate commercial real estate loans from years back are, oddly, somewhat protected themselves since their own payments don't change even if the property's value falls. It's the lender holding that loan, and by extension its depositors and shareholders, Who absorbed the risk if the borrower eventually can't refinance? Regional bank shareholders sit in a genuinely uncertain spot because the outcome depends heavily on execution. Whether management successfully works out troubled loans the way Regions, PNC, and M&T executives have projected, or whether losses arrive faster than reserves can absorb them the way they did at Zions on a smaller scale. On the other side, gold mining companies have benefited directly and substantially from the higher price environment in a way that's changed how their own projects get valued internally. Development stage gold projects publishing feasibility studies this year have shifted their baseline price assumptions to somewhere between $440 and $800 an ounce, roughly double or more than double what they used in prior years, which mechanically doubles or triples the projected value of a lot of projects without a single operational change on the ground. That's a separate phenomenon from the safe haven story, and the two shouldn't get collapsed together. It's really the second-order effect of central bank buying rippling through the mining industry, changing which previously uneconomical deposits become viable. Meanwhile, ordinary physical buyers, the coin and bar market that grew 42% year over year in early 2026, represent a smaller, more decentralized, but fast-growing version of the same behavior playing out at the household level. What should an informed investor actually be watching going forward, separate from any prediction about what happens next? A handful of specific, trackable signals matter more than most headlines. Watch the pace of loan extensions versus outright defaults on commercial real estate and quarterly bank earnings calls. Since that ratio tells you whether extend and pretend is still working or starting to crack, watch whether Western gold ETF outflows keep going even as central bank buying persists, because a widening gap between fast money and patient money usually resolves in favor of whichever side turns out to be right. Watch Federal Reserve commentary on regional bank capital adequacy and stress test results, since regulators tend to know about concentrated risks well before the public does. And watch whether central banks beyond the current roughly 20 active buyers start entering the market, because broader participation, instead of concentration in China and a handful of Eastern European states, would suggest this is turning into a genuinely global reserve consensus rather than a regional hedge. There's one more indicator gold analysts watch more closely than almost anything else, and it rarely comes up outside specialist circles. It's called the real interest rate, the yield on an inflation-protected government bond after accounting for expected inflation. Gold pays no interest and no dividends, so its main competition as an asset is whatever return you'd get from safely parked cash or short-term government debt. When real rates are high, meaning you can earn a solid, inflation-adjusted return just by holding a Treasury bond, the opportunity cost of holding gold instead rises, and that tends to pressure gold's price. When real rates fall or go negative, meaning your safe bond barely keeps pace with inflation or actually loses purchasing power, gold's lack of yield stops being a disadvantage because nothing else safe is yielding much either. This relationship has historically been one of the more statistically reliable drivers of gold's price over multi-year periods, arguably more reliable than headlines about crises or geopolitics. If you want one number that tells you more than most news coverage, well, it's the real yield on 10-year Treasury inflation protected securities. Watch whether it's rising or falling, and you'll understand a meaningful share of what's actually driving gold's next move, independent of any single bank headline. The shape of the yield curve matters too, meaning the gap between short-term and long-term government borrowing costs. An inverted yield curve where short-term rates sit above long-term rates has historically preceded most modern recessions, including the run up to both 2008 and the 2023 regional bank stress. That inversion hits bank profitability directly because a bank's basic business model is borrowing short through deposits and lending long through mortgages and commercial loans. When that spread compresses or inverts, the core profitability of ordinary banking gets squeezed, which is part of why banking stress tends to cluster around periods right after the yield curve uninverts, once balance sheet damage built up during the inversion finally becomes visible. It's worth being honest about what we don't know here, because intellectual honesty is what separates real analysis from prediction dressed up as certainty. Nobody can tell you with confidence whether the 2026 commercial real estate maturity wall resolves quietly through refinancing the way regional bank executives are currently projecting, or whether it produces the kind of visible failures that reawaken 2023-style panic. Nobody can tell you exactly how high or low gold goes from here, and anyone claiming certainty about a specific price target is selling you confidence they don't actually have. What the data does support, without much ambiguity, is that a multi-year shift in how sovereign institutions Think about reserve composition has already happened, and it didn't happen because gold got popular. It happened because a string of real events from 2008 through 2023 and into the ongoing 2026 commercial real estate stress have repeatedly reminded the people managing the world's largest pools of capital that even the safest seeming promises can fail quietly, without much warning, and that an asset with no counterparty at all does something nothing else in the financial system can replicate. There's a psychological pattern here that's worth calling out plainly because it cuts both ways and it's easy to fall into either version of it. One version is recency bias towards stability. Most people alive today have never personally lived through a currency crisis, a bank holiday, or a sustained loss of confidence in their national financial system. Because it hasn't happened in their lifetime, it's easy to assume it can't, which is exactly the assumption depositors at Silicon Valley Bank were operating under until the moment they weren't. The other version is the opposite error, treating every worrying data point as proof collapse is imminent, its own kind of distortion, usually driven by content that profits from fear rather than by the underlying evidence. The honest middle ground, the one central bank reserve managers actually appear to occupy based on their measurable behavior, isn't panic and isn't complacency. It's disciplined, unhurried diversification, adding a modest, growing allocation to an asset with no counterparty risk, not because collapse is certain, but because staying moderately prepared for a plausible risk costs little, while being caught completely unprepared, should it happen, costs a great deal. That's a different mindset than trying to time a crisis or call a price. It's closer to how a careful person thinks about insurance generally, weighing cost against consequence rather than guessing the date of the fire. In general terms, institutional portfolio theory treats an asset like gold differently from ordinary investments for a specific reason, and it isn't that gold is expected to outperform everything else. Most institutional research on gold's role in a diversified portfolio comes down to one specific statistical property, how it correlates with other assets during periods of stress. In ordinary conditions, gold's price moves largely independent of stocks and bonds, sometimes rising, sometimes falling, without much relationship to what equities are doing. But during acute financial stress, the kind that followed 2008 and briefly followed the 2023 regional bank failures, gold has historically tended to move opposite to riskier assets exactly when a portfolio needs something to hold its value. That property, low or negative correlation specifically during crisis periods, is mathematically different from an asset simply having a lower average return with lower volatility. And it's the specific reason institutional allocators have historically kept a modest gold position as a stabilizer within a broader portfolio rather than as a substitute for productive assets like equities, real estate, or bonds, which have historically compounded wealth over long periods in a way gold generally hasn't. None of this is financial advice or a recommendation for what you personally should hold, since that depends entirely on your own circumstances, time horizon, and risk tolerance, and those are questions worth working through with a qualified financial professional who actually knows your situation. But understanding why sophisticated institutions think about gold's role this way at least explains the mechanism behind the headlines, instead of leaving it as an abstract story about panic. And here's what this isn't saying, to be precise about it. None of this data suggests the U.S. banking system is on the verge of a 2008-style collapse, and the analysts we've cited, from Manulife to the Congressional Research Service, describe the current commercial real estate stress as serious and concentrated, worth watching closely, not an imminent systemic event. The dollar remains, by a wide margin, the world's dominant reserve and transaction currency, and nothing here says that's changing quickly. What the evidence does support is narrower to multi-year reallocation toward gold by the institutions, with arguably the best information and the longest time horizon anywhere, happening alongside a real, measurable, still unresolved concentration of credit risk sitting on regional bank balance sheets. Two verifiable facts sitting next to each other, and connecting them is a reasonable read grounded in exactly what happened the last time a similar kind of hidden balance sheet risk became visible all at once, back in March of 2023. That's really the idea worth carrying with you after this ends. For most of your life, and probably most of mine, the difference between money in a bank and gold in a vault has felt almost entirely academic. One was convenient, modern, productive. The other felt like something out of a history textbook. But the largest, most sophisticated financial institutions on Earth, the ones with access to information most of us will never see directly, have spent 4 straight years acting like that distinction matters again, and they've done it consistently across different governments, different economic conditions, and even through a 16% price correction that would have scared off anyone just chasing a trend. That consistency is the real signal here, more than any single headline about a bank or a price target. So here's the question worth sitting with. If the institutions responsible for managing entire nations' financial reserves have concluded that part of their safety net needs to exist outside the promises of any single government or banking system, what does that tell you about how they're quietly redefining the word safe? And does your own understanding of that word need updating too? I genuinely like to know what you think, so drop it in the comments. If this kind of grounded, evidence-based analysis is useful to you, consider liking the video and subscribing. And if you want to see exactly how the 2023 banking crisis unfolded step by step, there's another video linked right here that walks through what happened inside Silicon Valley Bank in its final 72 hours.